Hello, everyone. This is Tom Fox back again with Matt Kelly for another episode of the award winning Compliance Into the Weeds. Welcome back, Matt.
Hello, Tom. Good to be here.
Matt, I come today not to slay Caesar nor even honor him, but to bring about the next in line of corporate scandals, exceeding Boeing in many ways, the FDIC. That was one of the most scathing reports I've ever seen publicly released, and it came out last week. So, with that little bit of setup, what happened to the Federal Deposit Insurance Corporation last week?
Well, what happened was that the FDIC, which for those who are not familiar is the banking regulator, one of the primary banking regulators in the United States, it oversees the liquidity of most small banks. Wall Street banks are separately managed by the Federal Reserve, but the Federal Deposit Insurance Corporation manages the liquidity and soundness of banks and the depositor insurance that came about during the Depression and now is still in place today. So, lots of times, what the FDIC will do, if we want to start there, is if a bank is teetering, they will swoop in at 4:58 p.m. on a Friday, announce that they have seized a bank that is insolvent. They will restructure it over the weekend, and they will announce at 8:59 a.m. the following Monday that the floundering bank has now been resold or merged off into a healthier bank. And the FDIC used to do that all the time during the financial crisis. The FDIC has been around for many decades, which brings us to its corporate culture problems. So last fall, the FDIC was subject to a scathing, in-depth look from the Wall Street Journal of culture of harassment, old boys network, sexual harassment, heavy drinking, a lot of booze-filled parties at a FDIC training facility. The agency actually owned its own hotel right next door to its headquarters in Washington, D.C., and trainees would then gather there. They would all allegedly train and really get drunk at the end of the day. And then all sorts of untoward behavior would then ensue. It would ensue there. It would ensue in the regional offices. So that came out. Washington was not happy. The FDIC, which is governed by 5 directors who were appointed by the president, commissioned an outside law firm to do an independent investigation of its corporate culture flaws. And that report, all 234 pages of it, was released last week, and it is not pleasant reading. Lots of discussion about some really awful sexual or racial harassment that went on. Lots of talk about whistleblower retaliation. Lots of talk about the poor leadership of the FDIC chairman, Martin Gruenberg, who in one form or another has been one of the big bosses at the FDIC for nearly 20 years. And there's an awful lot that we could discuss here about corporate culture and the failures thereof, which is really what the FDIC has been under the hot seat or under the microscope for the last week or so now.
Well, Matt, you talked about culture quite a bit there. What interested me almost as much as the culture is how the structure of the organization played a role in all of this. And you noted in your opening that the FDIC has been around for a long time, since the Depression, and the way it grew up seemed to, if not lead directly to what we have seen in the report, but the structure itself really lent itself to that. So could you say a few words about the structure of the FDIC?
Sure. And true to this podcast name, we have to get into the weeds here a little bit on both the organizational structure of the agency and the personnel structure, both of which I think are important to appreciate. So the organizational structure is there is a headquarters in Washington, D.C., but there are also 8 regional offices throughout the United States. And then there are even more small field offices throughout the United States, because these could be teams that have to swoop in to, the Bank of Nowheresville in some obscure part of an obscure state somewhere. And they have to be ready to do that on fairly short notice if a bank is starting to unravel. So there is an awful lot of just decentralization, big, sprawling organizational structure throughout the United States. There's also the personnel structure here. So you start as a bank examiner, but you go through about 4 years of training when you are hired by the FDIC, where you're going out into the field, you're doing examinations, If a bank is collapsing, you might swoop in and do the weekend routine of repackaging and whatnot. But the younger, newer FDIC employees are non-tenured professors at a university. And they, in turn, are supervised by commissioned examiners. And I think that we could maybe continue the metaphor. That really is more like being a tenured professor at a university. The commissioned examiners lead the team of non commissioned people, and they work in very close quarters. They have an awful lot of influence over the non commissioned examiner's career prospects. So think about what all of this means is that you have this big sprawling structure with a layer of senior executives who have enormous power over a much larger cadre of junior executives or junior examiners, and they're spending a lot of time with them. You might be on the road with these people. You might be spending a weekend or two together. Back during the financial crisis, the FDIC examiners were working night and day, week after week, month after month, because banks were going, small banks were failing left and right. Come to think of it, the large banks were failing left and right too back then. But the FDIC can often be a high pressure workplace. So, like that old saying from, I think it was Mark Twain, familiarity breeds contempt and children. I mean, you got to know these people very well. And, it was ripe for opportunity for abusive practices and harassment and an old boys network that crept up. That was all documented in this law firm's report. But I think a lot of these culture problems were just rooted in the basic structure and mission and personnel of the organization.
Man, it seemed to me that this decentralized structure really gave much more power and authority to these regional offices all the way down to the individual examiners. And also, the tenure of employees who work there seemed to be quite long. So that perhaps your analogy of tenured versus non tenured faculty might be appropriate, that once you receive the commissioned or tenured status within the FDIC, you stayed there. And so you had people with long service records, but also lots of power accumulated through that long service. And that it really seemed like to me they were almost independent power centers within the regional offices of the FDIC. Did you get any sense of that?
Well, I think that's true, and that led to the chief complaint from a lot of employees was that was this old boys network, primarily men, primarily white men of older age who had been at the FDIC for a long time, who treated their field offices or regional offices as these sort of personal fiefdoms, and they could therefore say or do a lot of things that was probably unwise, or say or do things that may have been acceptable when they started decades ago, but are definitely not cool to be saying in 2024 when we do have a more enlightened and inclusive society. But that would lead to a lot of sexual harassment, a lot of partying on the weekend after you've been trying to close the book on the insolvent bank for 10 hours. And now you're going to blow off some steam at dinner on a Saturday night, and everybody's getting a bit too tipsy. And then you wind up knocking on the door of somebody at an inappropriate hour at a hotel in the middle of nowhere. That kind of thing could give rise. There was a lot of allegations of this old boys network looking out for its own, so that even when people did complain about management misbehavior, the errant managers were either promoted up or moved away from the problem, or the whistleblower was moved away to a different office, or the whistleblower was just probably pressured to go seek career employment elsewhere at some other banking regulatory agency. So it was a lot of figuring out ways to tolerate this bad behavior from management and not enough paying attention to inculcating a good, strong culture that didn't allow bad management behavior in the first place. That really seemed to be the guts of the report. And I think that the big lesson here is if you're going to assess corporate culture, start by actually just asking, what is the actual structure of the organization? What is the personnel design here? What is the mission of the organization? And do those things create these natural opportunities for misconduct if left unattended? And once you know that, then you can say, okay, now we know where these culture risks are. Now we know how to attend to them with proper management oversight and messages and disciplinary proceedings and protection of whistleblowers. And I don't know that the FDIC's management made that connection between its structure and its risks and what management was supposed to do.
Well, that really leads to the next topic I wanted to raise, which was a culture of abuse. And by that, I mean dressing down employees in an inappropriate manner. And the report gave some specific examples of at the very top of the organization. So I was wondering if you might talk about what you saw from the report around the way employees were treated and in a way that I don't think is literally appropriate anymore.
Well, there was a lot of criticism heaped upon Martin Gruenberg, who is the current FDIC chair. He has been the head of the FDIC for most of the last 13 years. And before that, he was also still a senior FDIC executive. So he has been around at the top in one form or another, either in the top seat or sitting next to it for most of the last 20 years. And Mr. Gruenberg was not painted well in this report. A lot of employees that the law firm interviewed, and they interviewed more than 500 employees for an organization that only has about 6,000 employees. So that's nearly 10% of the entire workforce this law firm reached out to as part of its investigation. But plenty of these employees said that Martin Gruenberg would come across as adversarial, prosecutorial, harsh, vitriolic. I could probably dig up a whole bunch of other adjectives along those lines. There's a entire section in the report devoted to Mr. Gruenberg's leadership shortcomings here. But basically, a lot of people, including senior executives who had worked with Mr. Gruenberg for years, said that he was somebody who had a propensity to shoot the messenger. And that is not good. If you're looking for a speak up culture and the people who know that they want to speak up also know that they might get metaphorically shot by the CEO hearing the message, that's not good. Now, Mr. Gruenberg did say that he never really considered that he was grouchy or unapproachable. He said that he was soft spoken and direct with people and occasionally intense. I would even give him some leeway on that point because he was a leader during some very difficult periods around 2008 and 2009 when there was an enormous strain on regulators such as the FDIC. But nonetheless, he did say that, later on, what I think was really telling was that he recognized that, quote, what he says or what I say and how it's received can be two different things. And I do think that is an important part of leadership that we need to call out here is that the leader is not just responsible for what he or she says. The leader is also responsible for how he or she is heard in the rest of the organization. So even though Mr. Gruenberg thought he was somebody who maybe was on point and well prepared and direct in questioning, maybe he did not know that other people saw it as he was a grouch. He was prone to outbursts of bad temper. He was somebody who did not tolerate hearing bad news and did not like being challenged. Maybe that was news to Gruenberg, but it wasn't news to the rest of the organization. And at the end of the day, that's the part of the corporate culture that matters. And the CEO or the leader has to meet the culture there, not just sit around thinking they misunderstand me. Like, so what, pal? It's their understanding that matters. If they can't understand you, you have to do better at being understood.
Matt, you have, of course, blogged on this, and you had a question, or you posed a question rather, in your blog post that I really wanted to pose to you in this podcast. And the question reads: fiefdoms, subcultures, silos, insularity, do those things persist despite your structure and mission or because of it? Were you able to answer that question in your own head?
I mean, I think it can depend on the structure, really. And that's why I mentioned earlier that if you want to have a good assessment of culture or misconduct risks at your organization, start by, for example, just looking at the org chart. Don't necessarily dwell yet on the leader or who the senior people are or the disciplinary actions or the lack thereof. Get to that later, and we can get back to that. But first, start with how is this organization built? If it is built in a very sprawling way, yes, then it might be very difficult for the central command to push its corporate culture out toward the hinterlands of the org chart, for lack of a better word. And so in that case, you'd be thinking more, well, that might be where we have people with a lot of power that goes to their heads is out in the hinterlands. Maybe you would want to think about like centralized hiring and disciplinary processes. Maybe you'd want to think about hiring and promotion processes and, making sure that the tenured professors of your organization don't have enormous power over the non-tenured junior faculty, so to speak, which does seem to be the dynamic that plagued the FDIC. Once those people got that in their heads, and maybe it had been that way for decades because for decades people tolerated it, but that those days are gone. But once those things take root, it can be very difficult to eradicate. So my gut is that the FDIC's problems were almost preordained or predictable if you look at the org chart. But the part that didn't happen was people didn't look at the org chart and say, okay, we are at high risk for this sort of misconduct. Therefore, we need leaders who will really engage about that. And it looks like Mr. Gruenberg did not engage in the right way about that. Not if the organization thinks that he's a big grouch, and plenty of people have been thinking about that for more than a decade. Maybe he should have thought about restructuring things so he could focus more on ethics and culture and acceptable standards, while other FDIC governors focused more on actual policy. Or maybe he hires some sort of chief operating officer for policy. And I have to admit, I have not looked at the downward part of the org chart all that much. Maybe they do have one. I'm not sure. But he seemed to be focusing too much on the work and not enough on the culture. There was a mismatch there. And I know that can be hard for leaders to understand and to master, but that is the job. That's why you ran for the big bucks job, to be the leader.
The structure of the organizational structure that you've articulated in your opening remarks, you talked a little bit about how the FDIC grew up. And my perception is in the Depression, the banking system was very different before even Glass-Steagall was originally enacted. And of course, that's been reformed or done away with in some part. But we had small regional banks and you couldn't load money across state lines. That went away I think in the 80s. But the structure that the FDIC grew up with focused on the regionalism of smaller banks, not the mega banks that are deemed too big to fail. And has that structure that grew up that way, that became the source of some of these issues of noncompliance, is that a structure that we still need for the US banking system today? So SVB, Republic, or any of the recent failures, was it advantageous to have lo- reg- regional or local examiners who could step in and not have to fly out from Washington and sort of relearn an entire system?
Well, that's a good question because the banking system is so highly regulated that, you might have multiple regulators pulling in different directions. We should note that for larger banks, the Federal Reserve would fill this role that the FDIC serves, but there are probably going to be some banks that are they FDIC leaning or are they Federal Reserve leaning? Who should be responsible for them? That could be in question. We have various state banking agencies who are always going to say, well, we matter too. And that can lead to some confusion. I, as a practical matter, I don't see that Congress is going to act to simplify banking oversight anytime soon, even though they probably could. And even if they did, you still have that federal state duality that I mentioned a moment ago. So, Tom, my short answer is I don't know. If there are banking regulatory professors out there who want to drop us an email and give us your thoughts, I'd be eager to hear it. But I do think that to a certain extent, we can wave that away for most corporate compliance officers who are private companies thinking more about ethics and culture. The big lesson here for you is to think about what are the things that drive culture risk in my organization? Is it the structure? Is it the mission? Is it not the actual people, but more the personnel planning or the personnel structure? Like I said, the junior versus senior or tenured versus non-tenured dynamic, which in one form or another probably exists at a lot of companies. You are short timer or you're a lifer. And that's really what we're getting at here. Um, but also, it is about things like disciplinary enforcement. No wonder the SEC and the Justice Department now talk about consequence management so often, because consequences were not really managed at the FDIC for decades. And it became just one of these open secrets. And we could talk about it in that way too. I mean, we could go on and on, but, at the end of the day, does the actual amount of regulatory oversight, could it be improved? Probably. Would that then lead to a better organization within the FDIC? It might, but we still have plenty of lessons to learn anyways, if for those of us here in the corporate sector, regardless of all of that.
Matt, I'd like to end with a hopeful note if that's possible in this situation, and that revolves around the size of the FDIC. This is not Boeing. This is not Wells Fargo. This is not Volkswagen. This is not Siemens. This is 6,000 employees. Now, admittedly spread across the 50 states and probably some territories as well. But in the corporate world, that's a relatively small amount of employees. And that with appropriate consequence management, you can make changes or at least start that change. Uh, because of the size of the FDIC, should there be the political will to do so, do you think it's possible they could turn it around?
I mean, yeah, sure, absolutely. It begs the interesting political question: is Martin Gruenberg going to be forced to resign? Republicans have already been calling for him to resign. He's a Democratic appointee. No Democrat that I'm aware of yet, no significant Democrat has called for him to resign. Although I think of somebody like Elizabeth Warren or Maxine Waters on the House side, if either of them stepped forward and said it's time for him to go, I think Gruenberg would go. But if you bring in the right leader, yes, sure, that you could then change the tone. And with a lot of the FDIC, you have senior people who can extend through multiple administrations. Grunberg has been around for, as I said, the better part of 20 years. He's been at the top as chair or vice chair or one of the five FDIC commissioners since 2010. So he's been there when the Republicans have been in. He's been in when Democrats have been in. If he left and they nominated a replacement, that person wouldn't be chairman if a future Republican takes over in 2025. But that person, even though they're a Democratic appointee, they'd still be there in a lesser role. There's plenty of ways that you could put the right people in. And yes, they'd be able to change the culture, I think. But it would require that group to have a lot of backbone to change up a lot of the other personnel who probably have been there for too long, misbehaved too badly, and need too much discipline. And, it would be a painful period, but could they get through it? Sure.
Well, Matt, I think I'm safe in saying we'll be able to revisit this issue again.
Thank you, Tom.